What's happened with the markets post the IIP data? You're looking at the markets really trading at, breaking 4,900, and that makes the headline of fresh lows for 2012. In fact, the year-to-date chart will be important for the market because after the Jan-February rally, which was stupendous, we have come off sharply. So there you go. At one point in time, we were making a gain of almost 24% for the market, and that's come down to 6% from a year-to-date perspective. So within 6 months, a lot has changed in the marketplace. 49.10 is being held for the index. Just take you through the components on the index which are putting pressure. Of course, on the gaining side, there's a BHEL and a Bajaj Auto, some traction seen in autos. But on the losing side, it's really Ranbaxy, ACC, Ambuja Cements, construction companies, capital goods majors, L&T down about 2.5%. Even the defensives have given way. So Ranbaxy, ITC, both have succumbed to selling pressure. You have some of the key infrastructure and commodity themes as well, which have lost ground.
Of course, the big macro event driving the equity markets is the IIP number, which has contracted by 3.5% for the month of March, dragging the overall number for the last financial year down to a level of 2.8%. And you've had capital goods, like Tanveer did mention, the fact that that's been the biggest culprit for the IIP number having contracted in the month of March. That's fallen by 21.3%. And as a result of that weak IIP number, you've had the effect of that play out on both the rupee and the bond market. So you've had the rupee fall further from earlier levels that it was trading at. So that remains under pressure. And of course, there is a fair amount of concern that continues to linger in the forex markets that you'll maybe see the Reserve Bank of India do more to rein in the currency. There's already a buzz in the market about possible action on the futures front, which does seem a little unlikely. But physical intervention in the currency markets is something that you'll continue to see. The question is, how much longer can the RBI continue to go on intervening in the currency markets? In the bond markets, you've seen yields come off marginally. It's fallen to levels of 8.3, 8.53, 8.54% from yesterday's closing level of 8.56%. This is being driven in the hope also of possibly some, the RBI possibly looking favorably at policy rates to the extent that you've seen a breakdown on the manufacturing output front. Also, the fact that you've got an OMO exercise, an open market operation exercise with the Reserve Bank of India today, which is going to hand something like 12,000 crores to the market. But remember, at the same time, there is a government bond sale today which will take out something like 15,000 crores. So on that front, it's net really even Stevens over there. But sentiment somewhere in the bond market seems to have perked up, maybe on the hope that you will possibly see the RBI look more favorably at policy rate cuts.